unlocking the secret behind resilient portfolios. Welcome to AIA Investments Learning. Today, we'll explore the importance of asset allocation, the foundation of a resilient investment portfolio. Asset allocation starts with understanding the different asset classes, the building blocks of a portfolio. Here are the main ones: equities, stocks, shares of companies that offer growth potential but come with higher volatility. Fixed income, bonds, loans to governments or corporations that provide more stability and regular income. Cash and money market instruments, highly liquid and low risk, but with lower returns. Foreign exchange, FX, exposure to different currencies, often used for diversification or hedging. Commodities, physical goods like gold, oil, or agricultural products that can protect against inflation. What is asset allocation? Asset allocation is an important driver of portfolio performance, balancing risk and reward by spreading investments across different asset classes. So, why is asset allocation so powerful and important? Different assets behave differently across market cycles. Each asset class responds in its own way to growth, inflation, interest rates, and market stress. Taking the 2008 global financial crisis for example, equities plunged as investors fled for safety, while government bonds performed well. On the contrary, during periods of slowing economic growth, central banks may cut interest rates, lift sentiment and boost risk assets like equities. At the end of the day, it is important not to overexpose to a single asset class. During market downturns, losses can hit hard with risk asset prices plunging and fear triggering suboptimal investment decisions, exiting at the low and missing out on potential rebounds. Instead, utilize different asset classes to diversify, protecting your investments when some are underperforming, and capturing returns when others are performing well. Asset allocation with professional oversight adds real value. By combining assets that behave differently, we reduce the impact of any single market shock. Through disciplined oversight and active portfolio management, it helps smooth the investment journey, manages risks across cycles, and helps clients stay on track toward their long-term goals. This is the essence of AIA stewardship. Asset allocation also shifts with life stages. For someone in their 20s, they have a longer investment horizon and higher risk tolerance. The focus will mainly be on growth, with the appetite for a higher allocation to equities, diversified with bonds and cash for stability and liquidity. As one moves into their 50s with retirement approaching, priorities shift to wealth preservation. Portfolios typically hold a larger portion in fixed income, with reduced equity exposure and adequate cash for flexibility and liquidity. The long-term impact is clear. Studies show that asset allocation, not stock picking or market timing, is the biggest driver of long-term portfolio performance. It helps you manage risk, avoid overexposure to any single market, smooth returns, reduce the impact of market volatility. Stay disciplined, focus on long-term goals rather than short-term swings. At AIA Investments, we believe in the power of disciplined, long-term investing. Asset allocation is a cornerstone in building resilient portfolios and powering our customers' financial well-being. Discover the power of AIA stewardship and take control of your financial future today.